Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Centrus Energy Corp. Annual Report. Centrus Energy Corp. offers a diverse range of businesses and services to the nuclear power industry globally. The company's primary focus is on supplying nuclear fuel components, which include separative work units, SWU components of low-enriched uranium, LEU, natural uranium hexafluoride, uranium concentrates, and enriched uranium products. In addition to its LEU segment, Centrus Energy Corp. also operates a technical solutions segment that provides technical, manufacturing, engineering, and operations services to both public and private sector customers. This comprehensive range of services enables the company to cater to various needs of the nuclear power industry, from fuel supply to technical expertise. The surge in Centrus Energy Corp.'s stock price over the past year can be attributed to several pivotal news events and strong financial performance. The company's exceptional CONE 2025 earnings, which significantly surpassed expectations, was a major contributor to this growth. With a net income of $27.2 million and a 67% year-over-year revenue increase to $73.1 million, Centrus demonstrated its ability to adapt to changing market conditions. The securing of major government contracts for high-assay low-enriched uranium (HALEU) production also played a significant role in the company's stock price surge. The contract extension from the U.S. Department of Energy and the substantial $900 million HALEU production award further solidified Centrus' position as a leading player in the nuclear fuel industry. In addition to these events, Centrus' expansion of uranium enrichment and manufacturing capabilities has also contributed to its growth. The company's plans to expand its Ohio uranium enrichment capacity and create new jobs have been met with enthusiasm from investors and stakeholders alike. The overall financial performance of Centrus Energy Corp. has also been a key factor in the company's stock price surge. With a total backlog of $3.8 billion extending to 2040, indicating sustained demand for its services, and an increase in unrestricted cash balance to $2 billion, the company has demonstrated its ability to manage its finances effectively. The growing interest in nuclear power as a reliable, carbon-free electricity source has also contributed to Centrus Energy Corp.'s stock price surge. The executive orders signed by President Donald Trump, aimed at reforming and quadrupling domestic nuclear capacity by 2050, have further boosted the sector's growth prospects. Overall, the combination of exceptional earnings, major government contracts, expansion of capabilities, robust financial performance, and broad nuclear sector optimism has led to Centrus Energy Corp.'s impressive stock price surge over the past year. Centrus Energy Corp. Market capitalization of $4 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Centrus Energy Corp. holds a significant advantage in their industry. Centrus Energy Corp. trades at a lower price-to-earnings ratio of 54 times and a higher price-to-book ratio of 5.4 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the LEU segment are multifaceted. On the growth side, long-term sales contracts, commodity market forward pricing indicators, interest income forecast, and signing new contracts with higher margins have been significant contributors to revenue expansion. The U.S. market has also experienced a 32% increase in 2025, further boosting revenue. In contrast, revenue decline drivers include the Import Ban Act and Russian decree, which restrict imports and exports of Leu from Russia, respectively. Foreign revenue declined significantly in 2025, contributing to the overall decline in total revenue. Large customer concentration also plays a role, with some experiencing significant declines or increases. Task orders from DOE, agreements with TNEX, and contracts with Fluor have been key drivers of revenue growth, offsetting some of the decline caused by import bans and foreign revenue decline. Overall, the interplay between these factors has shaped the revenue landscape in the Leu segment. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 13% from 2023 to 2024. However, there was a slight increase of 6% from 2024 to 2025, resulting in an overall decrease of $2.8 million from 2023 to 2025. In terms of profit margins, the company experienced a decline. The gross profit margin decreased from 35% in 2023 to 26.1% in 2025, indicating a substantial drop. Similarly, the operating income margin also declined from 16.3% in 2023 to 11.2% in 2025. These changes suggest that the company's profitability has been impacted by various factors, leading to decreased profit margins over the period. The company's financial performance indicates a steady increase in its ability to generate operating cash flow over the years. In 2023, the company generated an operating cash flow of $9.1 million, which rose to $37 million in 2024 and further increased to $51 million in 2025. This upward trend suggests that the company is becoming more efficient in its operations and managing its finances effectively. However, it's worth noting that there are discrepancies in the reported operating cash flow figures across different pages. On page 79, the operating cash flow for 2024 is listed as $37 million, while on page 108, it's reported as $55.1 million. Similarly, on page 161, the operating cash flow for 2025 is significantly higher at $524.7 million, compared to the figure of $51 million mentioned on page 79. Despite these discrepancies, all pages confirm that the company is generating positive operating cash flow, indicating a strong financial position and ability to meet its obligations. The overall trend suggests that the company's operating cash flow is increasing over time, which is a positive sign for its future prospects. The company's debt level and interest expenses have undergone significant changes. The data shows that long-term debt has increased from $472.5 million in 2024 to $1,174.8 million in 2025, a substantial rise of over $700 million. This increase is evident across multiple pages, with the total long-term debt rising from $486 million to $1,207.5 million. The interest expenses have also seen a significant surge, increasing from $2.7 million in 2024 to $14 million in 2025, representing a staggering rise of over 419%. This increase is attributed to the higher contractual interest expense and total interest expense on debt. The net change in interest expense has been as high as plus 983% from 2023 to 2025. The redemption of 8.25% notes resulted in a decrease of $74.3 million in debt level, but this was overshadowed by the overall increase in long-term debt. The company's financial situation suggests that it is facing increased costs due to its rising debt levels and interest expenses. The company's performance can be analyzed through its segments and regions. The Leu segment stood out as a strong performer, accounting for approximately 77% of the company's revenue in 2025. This segment has seen significant growth, with revenue increasing from $274 million in 2023 to $358.6 million in 2025, and gross profit rising from $107.1 million to $113.2 million over the same period. In contrast, the Technical Solutions segment experienced a decline in revenue, decreasing from $325.2 million in 2023 to $461.1 million in 2025. This segment's backlog extends to 2034, but its performance was not as robust as the Layu segment. Geographically, the United States region performed well, with revenue increasing by 75% from 2024 to 2025. On the other hand, Japan was a poor performer, with revenue decreasing by 12% over the same period. These regional variations highlight the company's mixed performance across different markets and segments. Management's outlook on the company's strategy is one of adaptability and resilience in the face of changing regulatory environments and market demands. The company acknowledges potential risks from legal challenges, government policy changes, and deteriorating relationships with U.S. agencies, which could negatively impact contracts and business prospects. However, management remains optimistic about the company's future due to growing demand for nuclear energy globally, government support, and favorable trade agreements. To capitalize on these opportunities, the company plans to adjust its cost structure and operations, evaluate organic growth or strategic transactions, and invest in advanced enrichment technology. Management is also exploring partnerships and technologies complementary to HALEU production and considering potential acquisitions or other strategic transactions to enhance the company's position. The company anticipates having adequate liquidity for at least the next 12 months and expects increased capital expenditures due to investments in manufacturing readiness and facility expansions. Overall, management's strategy focuses on adapting to changing market conditions while positioning the company for long-term growth and success in the nuclear industry. The company has made several key acquisitions and divestitures as part of its growth strategy. In terms of acquisitions, the company has invested heavily in expanding its manufacturing capacity at its Oak Ridge facility, with a $560 million investment planned for 2026. Additionally, it has acquired a long-term supply agreement with Orano for SWU contained in Layu, which will run from 2023 to 2030. The company has also made significant investments in Piketon, Ohio, including an additional $60 million investment for potential large-scale expansion of uranium enrichment and the construction of a 150,000 square foot training, operations, and maintenance facility. Furthermore, it has awarded contracts for HALEU production and deconversion to ACO, as well as Layu production to multiple bidders. In terms of divestitures, there are no mentions in the provided pages. The company's focus on acquisitions suggests a strategy of growth through expansion and investment rather than divestment. Based on the extracted summaries, it appears that the company has made it clear that they have no intention to pay cash dividends in the foreseeable future. This decision was stated explicitly in both 2024 and 2025, with no expectation of dividend yield in sight. However, there is no concrete information regarding share buybacks. While a specific page does not confirm whether shares were bought back or not, it remains unclear if any such transactions took place. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal several concerns regarding inventory buildup and supply chain disruption. One of the primary concerns is the potential for inventory buildup, as indicated by the backlog extending to 2040 on page 11. This suggests that there may be a surplus of inventory, which could lead to storage costs and decreased demand. Supply chain disruptions are also a significant concern, with several factors contributing to this issue. The reliance on third-party suppliers, page 5, and restrictions on imports and exports, pages 13, 18, and 65, create uncertainty in the supply chain. Additionally, the Russian decree limiting exports of Russian uranium products, pages 13 and 65, and potential for additional sanctions and other restrictions, pages 13 and 113, further exacerbate the issue. The Import Ban Act, pages 25, 33, and 113, also poses a significant threat to supply chain stability. The uncertainty surrounding trade with Russia, page 28, actions of Russia in the war against Ukraine, page 28, and potential disputes arising from shortages of material resulting from sanctions or restrictions, page 28, all contribute to the risk of supply chain disruption. Furthermore, disruptions in shipments and production due to burdensome regulation or transportation restrictions, page 29. Potential for suppliers to default on their obligations or file for bankruptcy protection, page 29, and material adverse effect on business, financial position, results of operations, or cash flows due to epidemics and other health-related issues, page 29, are also concerns. In conclusion, the extracted summaries highlight several concerns regarding inventory buildup and supply chain disruption. The potential for inventory buildup, reliance on third-party suppliers, restrictions on imports and exports, and uncertainty surrounding trade with Russia all contribute to these risks. That concludes the financial summary for Centrus Energy Corp. Feel free to comment below, and I will be happy to answer them when possible.